Balance sheet reports the snapshot of the company's financial position at a given moment. Let us now look at a typical balance sheet format. Assets is equal to liabilities plus shareholders' equity. Assets are divided into two parts: current assets and long-term assets. Liabilities are divided into two parts: current liabilities and long-term liabilities. Here is the fast track balance sheet example. Current asset is an asset on the balance sheet which is expected to be sold or otherwise used up in the near future, usually within 1 year or one operating cycle. Long-term assets are assets on the balance sheet which with future benefit of more than 1 year, such as fixed assets, property, plant and equipment. Current liabilities are considered liabilities of the business that are to be settled in cash within the fiscal year or the operating cycle. Long-term liabilities are liabilities with a future to paid in more than 1 year, such as notes payable or debt that mature longer than 1 year. The third important thing on the liability side is the shareholders' equity. The amount of stockholders' equity is exactly the difference between the asset amounts and the liability amounts. This is also known as book value of equity. Financial statements are professionally made using a double entry system, which is a 500-year-old accounting procedure. Double entry is a simple yet powerful concept, and each and every transaction will result in an amount recorded into at least 2 of the accounts in the accounting system. Let us look at the equation. Assets is equal to liability plus shareholders' equity. Left means debit, right means credit. Debit and credit is a powerful concept. Remember these simple tips. Increase in assets, debit. Decrease in assets, credit. Increase in liability and equity, credit. Decrease in liability and equity, debit. Let us now look at case study 5, cash and common stock. On December 1, 2007, Karthik starts his business Fast Track Movers and Packers. The first transaction that Karthik will record for his company in his personal investment of $20,000 in exchange for 5,000 shares of Fast Track Movers and Packers common stock. There are no revenues because no delivery fees were earned by the company, and there were no expenses. How do we record this transaction on the balance sheet? Let us look at the solution. Increase in its stockholders' equity account common stock by $20,000. Common stock will be increased when the corporation issues shares of stock in exchange for cash or some other asset. Cash from Karthik's personal investment increased by $20,000. Debit and credit in case 35. Increase in assets is debit. Cash increased by $20,000 and hence increase in cash is debit. Increase in liability is credit. Common stock increases by $20,000 and hence increase in common stock is credit. Continuing our discussion on balance sheet, let us now look at case study 6, purchase of vehicle. On December 2, Fast Track Movers and Packers purchases a truck for $14,000 by writing a check for $14,000. The two accounts involved are cash and vehicles or delivery truck. How do we record the above transaction in the balance sheet? On the asset side, Cash reduces by $14,000 and vehicle account increases to $14,000. On the liability side, no change in stockholders' position. How do we account this on the income statement? Here is an introduction to depreciation expenses. Karthik also needs to know that the reported amounts on his balance sheet for assets such as equipment, vehicles, and buildings are routinely reduced by depreciation. Depreciation is required by the basic accounting principle known as the matching principle. Depreciation is used for assets whose life is not indefinite. Equipment wears out. Vehicles become too old and costly to maintain. Buildings age, and some assets like computers become obsolete. Depreciation is the allocation of the cost of the asset to depreciation expense on the income statement over its useful life. Fastrack truck has a useful life of 5 years and was purchased at a cost of $14,000. The accountant might match $2,800, that is $14,000 divided by 5 years of depreciation expense with each year's revenues for 5 years. Each year the carrying amount of the van will be reduced by $2,800. The carrying amount, or book value, is reported on the balance sheet, and it is the cost of the van minus the total depreciation since the van was acquired. This means that after 1 year the balance sheet will report the carrying amount of the delivery van as $11,200, that is $14,000 minus $2,800. After 2 years the carrying amount will be $8,400, that is $14,000 minus 2 multiplied by 2,800, etc. After 5 years, the end of the truck's expected useful life, its carrying amount is 0. Debit and credit for case study 6. Vehicle asset increases by $14,000 and hence debit. Cash decreases by $14,000 and hence credit.